What I've noticed over the last several years is that investors, whether they be retail or institutional, have become much better educated as a whole on what ETFs are and how they work. But sometimes I'm still surprised at some of the myths and misconceptions surrounding ETFs.
Welcome to the Canadian Couch Potato Podcast, where we help you become a better investor with index funds and ETFs. In this episode, we're going to take a deep dive into the inner workings of ETFs, with the goal of clearing up some common misunderstandings about these products. To help, I've invited Erika Toth, a CFA charter holder and a director at BMO ETFs, whose role is to help both investors and advisors understand how these funds are structured, how they trade, and how they should be used in a portfolio. Erika is based in Montreal, but she joined me in our Toronto studio for a chat. And my guest on the podcast today is Erika Toth from BMO ETFs. Thanks for joining us, Erika.
Thank you so much for having me, Dan.
Okay, so let's talk a little bit about your role with BMO, because I think that it's an interesting sort of segue into this idea of how the ETF landscape has changed over the last few years. You meet with a lot of advisors and talk to them about how they can use ETFs. What are some of the major changes in the industry that you've highlighted during these conversations?
Well, my role on a day-to-day basis is I consult with discretionary portfolio managers and institutional investors now as well. I also help retail investors become better educated on ETFs and how to use them. What I've noticed over the last several years is that investors, whether they be retail or institutional, have become much better educated as a whole on what ETFs are and how they work. But sometimes I'm still surprised at some of the myths and misconceptions surrounding ETFs, and that's where my role comes in. So the Bank of Montreal essentially pays me to be a nerd when it comes to ETFs and become as informed as possible, so I can help investors and advisors better understand the intricacies and how to integrate them into their portfolio for best results.
Okay, great. So maybe we can talk a little bit about some of the misunderstandings around ETFs. I've certainly heard a lot of them from readers and listeners over the years, and even from advisors, people who you would expect would be more familiar with the products and how they work. One of the key things I think that people fail to understand is the similarities between ETFs and mutual funds, and also the important differences between them. So can we talk a little bit about how ETFs and mutual funds are pretty similar?
Yeah, absolutely. So let's talk about the similarities first. ETFs and mutual funds, at the end of the day, are both pooled investment funds. Both are actually regulated by the same national instrument. We call it National Instrument 81102, or the investment funds regulation. So that's another similarity. Both provide investors with instant diversification instead of trying to pick individual securities. They offer the ability to reinvest distributions or set up a DRIP plan. As well, low initial requirement in terms of your initial investment. So those are some of the main things that ETFs and mutual funds share in common. But where they differ is that ETFs trade on the stock exchange. So intraday trading. That's the big difference. Whereas mutual funds trade once a day at the end of the day, so offer daily liquidity, and anybody who's either buying or selling a mutual fund gets filled at the same price, which is the end of day NAV, or net asset value of that mutual fund. Another difference between ETFs and mutual funds is the bid-ask spread. So ETFs have a bid-ask spread. That's the difference between the price you're able to buy the units for at any given time and the difference between the price you're able to sell the units at any given time. So there's a spread with ETFs. And this difference represents the market maker's compensation for making a liquid market on that security. Whereas with a mutual fund, there's no bid-ask spread. There's no difference in what you're able to buy it for, what you're able to sell it for, because everybody's getting that same price, the end of day NAV. Another difference is with an ETF, there typically is no pre-authorized contribution plans or systematic withdrawal plans that you can set up and just set it and forget it. But with mutual funds, there is that functionality. So you're able to have a pre-authorized contribution set up directly from your checking account and invested in the same mutual fund every month or biweekly, for example.
So that has always been really one of the major drawbacks of ETFs, in my opinion, like at least for the average retail investor, right? So if you're a type of person who puts $100 a month in your RSP, ETFs are really not a suitable vehicle for you. Or if they are, you've got to pool a lot of those contributions and only make very infrequent trades. Now, some people will say it's not a big deal anymore because there are brokerages now that offer commission-free ETF trades. So what we didn't talk about, one of the differences, of course, when you buy or sell an ETF, most brokerages charge you a commission. In the industry, it's typically about $10. But there are some brokerages that offer commission-free ETF trades. But let's talk a little bit, let's go back to talking about bid-ask spreads, and we can talk a little about how trading ETFs is not necessarily free, even if you're not paying, that typical $10 brokerage commission. So can you talk about how the bid-ask spread contributes to an investor's trading costs?
Absolutely. And I think it's important for investors to be aware of the different aspects of the costs of ETF ownership. So the other components that you want to be aware of course, are the MER, or the management expense ratio. There's the bid-ask spread, which we'll get into in a second. Any commissions to trade the actual ETF, but also things like tracking error or discount or premium to the net asset value. So in terms of the bid-ask spread, as I mentioned a second ago, what that is that's the difference you can buy the units for at any given time or what you're able to sell them for on the market at that point in time. And that represents the cost to the market maker if they were to buy or sell the entire underlying basket. So to compensate them for the risk of making that market.
Okay, Erika, a minute ago you mentioned the term market maker. Can you describe a little bit about what a market maker is and its role in providing liquidity for an ETF?
Yeah, absolutely. So first of all, I'd like to preface that, and great question, by the way, because I think a lot of investors misunderstand that. But I'd like to clarify because ETFs are not like a stock in the sense that for a stock, there's a finite number of shares that are available for sale on the market that are trading, barring, of course, any share issuance or share buybacks. But with an ETF, it's an open structure. So what that means is that the ETF provider can issue new shares or redeem shares of that ETF based on the supply and demand in the market. That said, the way the ETF ecosystem works and the way that the liquidity is provided to the market is that there are three levels of liquidity for an ETF. So the first level is what we call the natural liquidity of an ETF, and that's the number of shares trading on the exchange, the number of shares that, let's say, buyer A is willing to buy from another investor, investor B. So that is the number of units that are exchanging hands between different market participants. So an ETF that is larger, more mature, that has been around for a while, typically you will have more of what we call natural liquidity. So there's going to be more units simply exchanging hands directly on the exchange from one investor to another. Now, the second layer of liquidity, this is where the market making activity comes in. So the market maker, these are the large institutions in Canada. So typically the big banks, for example, tend to be market makers on the ETFs. Now, market makers are responsible for creating liquidity in the ETF market. They're responsible for posting bid and ask quotes, so the number of shares available either for sale or for purchase at a certain price, and they're responsible to keep the ETF price in line with its net asset value. Now, the third important layer of liquidity is the ETF provider. So if there's a large buy order, let's say, what happens in that case is that the ETF provider delivers a creation unit of that ETF, typically about 50,000 shares of that ETF, to the market maker, who then buys the underlying securities of that ETF and then offers those units of the ETF for sale and posts, a bid and an ask quote for that ETF for sale.
So that might occur, for example, if you were a pension fund and you were buying $10 million worth of a bond ETF. You're not going to buy that from other investors in the market, and maybe not even from the market maker directly. The ETF provider is going to have to go out and create those new units and then introduce them into the market.
Yeah. So typically for an average retail investor who's maybe trading $5,000 or $6,000 of an ETF, the market maker and the ETF provider are not going to have to go and create more units of the ETF. It's really only if there is a large buy or sell order that exceeds the current quantity of units or the current supply and demand.
Okay, now there's another layer of liquidity that I think we'll discuss, which, and I've seen this, as someone who trades ETFs frequently for my clients. A lot of times ETF providers will say, well, the liquidity of an ETF isn't determined by how frequently that ETF is traded, right? It's determined by whatever the underlying holdings are. So if I have an ETF and it holds a bunch of large cap Canadian stocks, even if the ETF doesn't trade very frequently, that in theory should be very liquid because all the underlying stocks trade very frequently, right? In practice, though, I've certainly seen this. I think maybe some of our listeners would have seen it as well. An ETF that is maybe less popular than another will trade with a wider bid-ask spread than one that is traded very frequently. So there is some level of liquidity that is determined by how frequently the ETF shares themselves are traded. Is that fair?
That's fair, absolutely. So as you mentioned earlier, yes, typically the liquidity of an ETF is reflective of the underlying securities. The ETF can only be as liquid as the underlying securities. And that's actually a misconception that I encounter a lot as well, is oftentimes even sometimes advisors will look at the trading volume before looking at the bid-ask spread of a security, and I think it's really important to understand the liquidity of an underlying market. Now, in terms of larger and more mature ETFs that have more developed what we call natural liquidity, or more buyers and sellers meeting up directly on the exchange, that's where you'll see sometimes the ETF itself is more liquid than the underlying asset class and will trade even at a tighter bid-ask spread compared to the underlying asset class. So great examples of this would be, for example, the bond market, which tends to be less liquid, and also in the preferred share market, where if you're trading individual preferred shares, you'd see, very, very wide spreads, whereas with some of the largest preferred share ETFs in Canada, they would trade at a very tight spread, so a penny spread, where that would be unheard of with the underlying itself.
Yeah, so this is an example of how ETFs can make transaction costs a lot lower for the average retail investor. So bonds are a good example, right? There are a lot of bonds, for example, that are purchased by pension funds, insurance companies, these big institutional investors, and they never trade, right? So there's not a lot necessarily of price discovery. So in other words, people don't really necessarily know what a bond is worth because there's no market to trade it. Whereas and individual investors are not going to go out in most cases and buy 100 individual bonds because it would be extremely expensive.
Impractical, yes.
To do it. So an ETF which will buy, thousands of bond issues and then package them up and make them available to you on an exchange, it's a very practical way of allowing you access to an asset class that would otherwise be very expensive to buy.
Yeah. And I would say that in this sense, ETFs really magnify their own advantages, especially in the harder to trade asset classes. And that's why they're becoming increasingly popular with institutions as an investment vehicle. Bonds themselves, because they trade over the counter and we can't see the prices of those underlying bonds at any given point in time, the ETFs do provide that sort of transparency or that price discovery where average investors wouldn't normally have that.
Right. So I want to go back to a comment you made a minute ago about advisors who you talked to who would look at the trading volume of an ETF, for example. I think it's fair to say that that is reflective of what people would do if they're used to trading stocks, right?
Absolutely.
So when people trade individual stocks, I think most people understand, at least if you're an experienced stock purchaser or stock trader, you know that if there's increased demand for the stock, it will drive the price up. So if, for example, you were looking at a small oil company or a resource company, something like that, a fairly small company, a very large order to purchase, for example, would probably drive that price up significantly. So I have certainly heard a lot of people say, ETFs are becoming more and more popular. With more and more people buying ETF shares, isn't that going to drive the prices up? So can you explain why it doesn't work the same way with ETFs as it does with stocks?
Absolutely. So I think that that's really one of the key misconceptions out there. With an ETF, at any given point in time, the percentage of the total investable amount of that stock that's out there that is owned by an ETF is going to be very small. So in other words, ETFs would own maybe about 6% of global markets on the equity side and about 2 to 3% of global markets on the bond side. So even a very large ETF, it would be very, very difficult for that ETF to move the price of a security held within it because it only represents a very small percentage of the total ownership of that stock or bond.
Now, one of the other things, though, is structural, right? In the sense, and you alluded to it earlier when you said an individual stock has a finite number of shares, right? So, in other words, if as a public company, you might have issued 1 billion shares, and investors just trade those 1 billion shares back and forth. With an ETF, you might launch a new product with, 2 million shares, let's say, would be a typical launch. And if there's huge investor interest, you're not just trading those 2 million shares, you're creating new shares.
We're going to be creating more units, absolutely.
Yeah, that creation process works?
So to meet the demand, if there's more demand from purchasers than the actual number of units out there, what happens in that case is that the ETF provider works with the market maker to create new units of that ETF. So the process here is that the ETF provider would create new units. It's typically a creation unit or a creation basket of about 50,000 new shares at a time. And the market maker would go ahead and purchase all of those underlying securities, deliver them to the ETF company, and the ETF company delivers to the market maker the number of units to post available for sale of that ETF. And one comment that I wanted to make, because we talked about how it would be very difficult for transactions in an ETF to move the price of the underlying securities. So this is definitely true for large liquid markets such as the Toronto Stock Exchange, the S&P 500, or the MSCI EFI, the developed markets. But if you start getting into less liquid or smaller cap markets, then this could be true. So if a particular ETF holds a number of very small cap companies and the ETF becomes large and it represents a larger percentage of the total outstanding float for a particular security, that's when, yes, you could see the ETF move the market for something, but it's very, very rare. And one thing that I just wanted to go back to, because we spoke about trading volume and the tendency to look at trading volume if you're an investor that's being used to trading stocks. Another thing that I often point out in my discussions with advisors is that typically the data that you see in terms of trading volume on many data feeds is only reflective of the TSX, of the Toronto Stock Exchange. Now, what a lot of people aren't aware of or don't consider is the fact that there are 13 different trading exchanges in Canada that ETFs can trade on. The TSX would represent the largest share of ETF trading, so tends to be about 20 to 25% of all ETF trades that occur on the TSX, but that means that the remaining 3/4—
It's that low. Yeah, 20 to
25,
yeah.
about 25%, depending on the ETF, of course, but overall in general. And then that means that the other three quarters is spread out over the rest of the exchanges, and you might not even see that when you're looking at the trading volume. So that's important to consider.
Yeah. So in general, the ETFs probably trade more frequently than you would believe by looking at the data you're getting from your brokerage, for example.
Yeah, that's right. So there's a couple ways to check it and to verify to get a true picture if you really want to see like consolidated trading volume. Like there's a website, stockwatch.com, where you can plug in any security, whether it's an ETF or a stock that's listed either in Canada or in the US, and you can see the consolidated volume quote, and you can see the number of shares that have traded on each of the exchanges. So that's a neat thing to check if you are looking at trading volume. Another thing is if you work in the industry, you can set it up on your Thomson terminal so that you get a consolidated volume quote directly.
Well, that kind of leads nicely into the next line of questioning that I had for you, which is to talk about trading tips for ETF investors. Now, here I'm thinking, again, about your typical retail investor who's purchasing maybe a couple of hundred shares at a time, not making enormous purchases. But let's talk about some of the sort of best practices when placing ETF trades and some of the common mistakes that you hear. So one of the things that I have always encouraged investors to do, and so have all the ETF providers, by the way, is to use limit orders when making purchases or sales. So can you describe what a limit order is and why it's important?
So that's something that we definitely recommend as a best practice for ETF trading. What a limit order is when you're putting in your trade, you're setting a price, and you'll get filled for your trade at that price or better if the market moves to your advantage. Now, why this is important is that it establishes a price or a total value for your trade, so you know exactly what you're going to get filled at. But also in fast-moving markets, you have the ability to just really determine what you're going to get filled at.
Now, I think it's really important because when I've brought up this idea before to people, and like especially when you phrase it that way, like you're going to get it at your stated price or better, people think of this as though they're like haggling at the bazaar, right? Like they're saying, well, I'm going to put a bid out there. Like I only want to pay $20 a share. And if it goes up, then I'm going to hold back and see if somebody will come down to my price. An exchange doesn't work like that. So I think, can you help us kind of get the message across to people that placing a limit order is there to make your order predictable, not necessarily to get you a better price?
That's right. Now, the prices that investors see when they're looking at the quote, that's reflective of the value of the underlying basket. And typically the spread is going to be pretty small. So it's the value of the stocks or bonds in that basket at any given time. So trying to haggle is not going to work. And the markets are very liquid. ETFs are a very liquid structure, and the market makers ensure that the trading price is as close to the value of the stocks or bonds in that basket as possible. So there's not very much leeway at any given point in time. That's what those underlying stocks or bonds are trading for. So it's not like you can kind of try and negotiate and get a better deal on something unless the market moves down. In which case, of course, move your limit order down. You can put in a lower price if you're buying then.
Right. So that's what it comes down to. If you put in a limit order that you offer to buy the shares for less than they're currently listed for, your order is just not going to get filled.
It's just not going to get filled. It's just going to sit there. And if you're a retail investor, you may miss out on getting into that position. Like you don't know where it's going to trade in the coming weeks or months. So if you put your limit price too low and you're trying to get a better deal, well, your money might be sitting there in cash and the market might run up another 10%.
Right. So just to distinguish a limit order, so the other major type of order that investors would use would be called a market order.
That's right.
So can you explain what that means and how that might lead to a different outcome if you used a market order with an ETF?
That's right. So a market order would be you put in your buy or your sell order and you don't specify a particular price that you want your order to get filled at. And the risk with that is if the market moves, let's say it moves way up, you might end up paying more than you thought you would be paying for the securities, or conversely, if it moves down quickly, well, as a buyer, you wouldn't maybe
you would
mind,
get a better price,
but
yeah.
when you're selling, you might get less than you thought you would be getting. Now, in a fast-moving market too, like markets can be volatile, things can move around a lot. So that's why we always suggest to use a limit order.
One of the other things that comes up when trading ETFs is that, let's say you're buying a BMO ETF, it's listed on the Toronto Stock Exchange, it's bought and sold during the hours the market is open here in North America. It's traded in Canadian dollars, but the underlying stocks, you could be buying an ETF of U.S. stocks or an ETF of international stocks, and those stocks trade on a different market. They don't trade on the TSX. What are some of the problems that can come up when trading these international equity ETFs, and how can you avoid them?
So what we suggest as a best practice is always trying to trade, if possible, when the market for those underlying securities is open. So for example, for the European equity markets, the Euronext exchange is open until about 10:30 in the morning Eastern Standard Time. The London Stock Exchange is open until about 11:20 Eastern Standard Time. And I should also mention that there's actually no overlap where the Australian, the Chinese, or the Japanese markets are open at the same time as ours. But we do always suggest, when possible, to trade when the underlying market is open, because typically the spreads tend to be tighter then. So that reduces your cost of owning that ETF. Now, typically, if you're a retail investor and you're buying, let's say, $3,000 worth of a particular ETF and you're planning on holding it for a year maybe or 2 years, or you're not sure, but let's say you're a longer term type of a buy and hold investor, that bid-ask spread is typically not going to have much of an impact on your costs over the longer term. But if you tend to trade more frequently, then it's something that you should definitely be aware of and taking into account. Now, typically, yes, the spreads tend to be tightest when the underlying markets are open. But for the large liquid markets, such as the S&P 500, the Toronto Stock Exchange, or the MSCI EFI in the case of international equities, typically those spreads are going to be quite tight anyways, because those are very large and liquid markets.
So this is probably not something that the typical index investor needs to worry about if they're buying a very broadly diversified fund with. So, for example, an international equity fund might hold 800 or 900 stocks in a dozen or more countries. Chances are you're never going to get the timing right anyway.
That's right. Exactly.
And unless you're making an enormous trade, you probably don't need to put too much attention into that.
That's right. And I think that's one of the dangers, especially for retail investors, is to overthink this type of thing. When the underlying markets are open, or bid-ask spreads, or even trade or limit orders, or how to price your limit order. Because if you start to overthink those things, it means that you're probably going to be less efficient in terms of just getting your money invested and sticking to your financial plan, and just keeping it simple and rebalancing as needed.
Exactly. Although there is one aspect of this that I think is important, even for small retail investors. It's one that I've got firsthand experience with, and we make a real concerted effort, is there are a number of days every year when the U.S. market is closed, but the Toronto Stock Exchange is open.
That's right.
And if you're buying U.S. equities on a day when the U.S. markets are closed, what kind of things can happen?
So those ETFs actually still trade, and that's a really good example, because I had an advisor reach out to me not too long ago on one of those days and saying, hey, how come this ETF is trading on the S&P 500? Isn't the market closed? Yeah, absolutely. But it's still trading, and the market makers are still able to price it based on futures contracts. But what happens is that you'll see the spreads are a lot wider. The bid-ask spread on that is not going to be, let's say, a penny or 2 pennies. It's typically going to be a lot wider, because the market makers are assuming more risk to provide a liquid market on that security when the market is closed.
Yeah, and this is one I would encourage people that even if you are just making a modestly sized trade and it's Martin Luther King Day or one of the U.S. holidays where the Toronto market is open, just do it tomorrow.
That's right.
Yeah.
That's a great best practice.
I wanted to talk to you a little bit about kind of the inner workings of ETFs because I think, again, people don't necessarily understand how they work. We know that ETFs generally have low fees, low management fees, especially compared to, traditional active mutual funds. But there are fees, and a lot of people ask me, how does an ETF take its fee? Like I never see it deducted on my brokerage statement or anything like that. So how do they charge fees and how is that, what goes on behind the scenes there?
Sure. Yeah. So that's typically handled on the ETF company side internally. That management fee is actually deducted on a daily basis from the net assets of the fund. So what you're seeing on your statement as an investor in terms of performance is already net of that fee. And typically when you go and check performance numbers, let's say on investment analysis websites such as Morningstar, those numbers as well are already net of performance. So it's deducted by the ETF company in-house. And when that covers is the fund company's daily expenses. So their costs to pay salaries, their utilities, their research, their trading platform. So that's what those management fees go to pay for.
One of the things that I think most investors like when they buy, especially income-oriented investors, is a consistent cash flow. So if you are an ETF and you have, again, hundreds of stocks and you're getting these dividends at a random schedule, the investor might want a predictable amount of income every quarter. And it's not going to be consistent over the very long term, but you don't want it to be haphazard. You want some expectation of what you're going to receive. So what mechanisms do ETF providers use to smooth out those distributions so they're roughly similar every month or every quarter?
So in general, what we try and do is pay out all of the income we receive, either in dividends or in interest coupon payments from the underlying securities. But we do use what we call smoothing to make sure that the dividends are somewhat consistent from one payment period to the next, because we don't want them to be too lumpy or all over the place. We want them to be fairly predictable for investors so they have a sense of the kind of cash flow that they can expect in a product. That's not to say that they're fixed distributions, but just to give it a little bit more predictability.
So do you do that by holding back a little bit of the dividends that you have on hand, or do you do it by adding a little bit of what's called return of capital to give you a little bit more, but then of course if you pay out more income than you've received, the investor has to understand that that amount isn't taxable. That's why it's called return of capital. It's sort of like giving you your own money back.
Yeah, so sometimes there is return of capital as a result of the smoothing process, but we do try and pay out as much as we can.
And we should say, too, that ETFs, mutual funds, are obligated to pay that out. It's not like they can
withhold it and not pay it. If we don't feel like paying you a dividend, you're not going to get it this month.
Well, now, I guess in theory, they could reinvest all of the dividends and never pay out any of the cash, but they still have to hand you the tax bill at the end. So on your T3 slip, for example, if the fund received $1 in dividends per share, you're going to get a tax bill for that, even though you didn't get the actual cash.
Yeah. And actually, that brings me to another point, a question that I get so often. There's a certain time of the year around tax time where I get about 1,000 questions every year regarding cost-based adjustments for capital gains.
Right. So let's talk a little bit about this, because for ETF and mutual fund investors, there's really two kinds of capital gains that you need to be concerned about, right? The first is at a very personal level. If you sell your ETF shares for a profit, you realize a capital gain. People, I think, know that.
Yeah.
They have to report that. But what happens if I'm a buy and holder? I never sold any of my ETF shares during the year. I get my T3 slip at the end of the year and it says there was a $2,000 capital gain. Where does that come from?
So where that comes from is within the ETF, there might be some rebalancing that takes place over the course of the year to bring the weights back in line to, let's say, the index that it's tracking. There could also be some adjustments if there's any currency hedging going on. There might be some gains on the forward contracts that are used for creating the currency hedges to to hedge out currency risk. So an investor, even who's not buying or selling their individual units, might end up with a tax bill because of some of these changes within the portfolio. And capital gains within an ETF structure, it's treated consistently across the industry, by the way. So BMO treats it the same way as every other ETF provider in Canada. The capital gains are reinvested. So what happens is that the average cost base of the investor is adjusted upwards to reflect that capital gain within the portfolio, and the investor is issued a T3 or a tax slip that reflects capital gains of that amount. So in the industry, these are referred to as phantom distributions. There's a really good article, if you Google, the Globe and Mail did it a little while ago as well, on phantom distributions and ETFs and how they work. I also wanted to mention a PDF that I use very often with investment advisors and portfolio managers, because a lot of investment advisors sometimes need to be reminded of this stuff as well. There's a piece, it's called What to Expect During Tax Season. It's an FAQ piece, and it walks through the different types of distributions you might see in an ETF structure from a tax perspective, and it talks about the reinvestment of capital gains distributions in an ETF structure. So I find this piece is super handy. I use it all the time, probably about 1,000 times every single year, and you'll find a link to that in the podcast notes.
Yeah, we'll put a link to that on the site for listeners who can download a copy as well.
And sometimes I even recommend that advisors share that FAQ piece with their clients' accountants so that the accountant can be aware of that mechanism and how it works and what adjustments they need to make.
So this is an interesting point that you raise about that because and this is not to criticize accountants, but I think it's fair to say that a lot of accountants don't necessarily appreciate the subtleties of ETF taxation. And so they may not be aware of these kinds of things as well. One of the things that we have seen improving a little bit is you talked a little bit about when an ETF distributes a capital gain that has already been reinvested. In other words, you didn't receive any cash for it. You need to increase the cost base of your holding. Otherwise, you're going to pay tax on that money twice.
That's exactly it.
Now, it used to be, my colleague Justin Bender and I did a white paper a few years ago describing how people had to look this information up and make the adjustment manually. In the last few years, I have seen more and more discount brokerages making those adjustments automatically.
Yes.
But it's very inconsistent across the industry. So a warning to ETF investors who have taxable accounts, try to make an effort to do this yourself and make sure that your brokerage is doing it properly. If they are, great. It saves you a lot of bookkeeping. But if they're not, you need to keep track of it yourself.
So I would absolutely agree that you should try and confirm before going into tax season and rushing around with all the tax slips, try and get them to your accountant, to confirm with your brokerage whether that adjustment is being done automatically or not. A lot of the major firms in Canada do the adjustments automatically at this point. 7-8 years ago, that may not have been the case, but things have evolved and technology has gotten better, reporting has gotten better. And yes, to your point, there's some great accountants out there that are experts in the tax code and helping their clients save money on taxes, but they're not necessarily experts in the subtleties of the ETF structure and how it works from a tax perspective.
All right, so I wanted to wind up today by talking to you a little bit about what I think is kind of an annoying trend in not so much in the investment industry, but more in the media, although a little bit of both. And that is what I call like fear-mongering about ETFs. One of the things that you will often hear is as ETF investing, or at least as index investing becomes more popular, markets become less and less efficient, and they're indexing almost becomes a victim of its own success. What do you think about that argument?
So first and foremost, the advice that I would give to investors is to always consider the source of that type of report, because oftentimes it will be a portfolio manager of an actively managed mutual fund, and they may be losing assets. Clients that are selling their units in order to move into ETFs, and there may be a certain degree of frustration there. So I would always consider the source of the information first and foremost. The second thing is I always I like math, okay? So I always like considering what are the actual numbers and does this claim make sense? So global equity markets are roughly $44 trillion in value, and ETFs represent about 6% ownership of that. Global bond markets are over $100 trillion in value, and bond ETFs represent 2 to 3% ownership of that. So some of these claims, I mean, given the actual math behind it, just does not make sense. Another piece that I think is probably the best piece written on the topic, or one of them, definitely one of my favorite, is the report. It's called Are Bond ETFs Dangerous? And it's actually been written by Ray Kurzero, who's Director of Research at PWL Capital. So if you're interested in the topic, I would suggest that you read this piece actually, because he does a great job in that piece of debunking the myths, and it's really based on empirical evidence. Like he's looking at, during the financial crisis, during 2008, how high yield bond ETFs traded in response to the crisis. So a lot of the underlying high yield bonds went no bid. They were not trading at all, but the ETFs continued to trade and provided liquidity to that market, provided price discovery to that market when the underlying market was not even functioning. So I think that there's some great points in that report, and that's why I wanted to mention it specifically.
So let's wind up by just asking you where you see the trends in this industry going now. It wasn't so long ago that, ETF and index fund were two synonymous terms. It's been a long time since that was true. The industry is exploding and growing. Let's talk about where you see it headed in the next 5 years.
So I think the line is becoming more and more blurred between ETFs and mutual funds, because ETFs used to be associated with a passive index tracking instrument, and mutual funds used to be associated with a traditional actively managed portfolio. Now, we've seen in the last several years, over the last year, there's been more than 11 new providers entering the ETF space. A lot of them are companies that run mutual funds as well. And there's been a lot more products launched that would fall under the actively managed side of things, or the sort of smart beta, which is quasi-actively managed. In fact, there were about 200 new ETFs listed on the Toronto Stock Exchange last year alone. The majority of the assets in the ETF business in Canada are still passive index tracking, traditionally passive ETFs. So, more than 2/3 actually are still passive index tracking ETFs in terms of the asset base, but we are seeing the active side of things grow. So I think that line between ETFs and mutual funds is becoming more and more blurred. I do think that the ETF landscape, the ETF business is going to continue to grow by leaps and bounds. We saw the ETF industry in Canada double since 2014. As of now, we're at about $179 billion in assets under management. It's still only about a tenth of the size of the mutual funds landscape in Canada. But we do think that over the next 5 years that you're going to see the ETF industry grow to possibly even above $400 million. Another thing that I think it's important to clarify is that ETFs are typically associated with being low cost, but I think it's really important to investors to be aware of what they're buying. Just because something's in an ETF wrapper doesn't necessarily mean it's low cost either. In fact, some of the most expensive ETFs in Canada have all-in fees above 1%. Some of them even above 2%, depending on the structure. So I think that's really important to look at and to consider. You need to know exactly what you're buying.
I think it's fair to say in general the ETF industry is kind of going the way of the mutual fund industry, in that it's just, it's exploding not only in popularity but just in the variety of products. It's becoming more and more confusing for investors to navigate, and it's become more important, I think, for the average investor, especially those who, are just looking to do a simple index-based strategy, to just try to keep it as simple as possible and try not to get distracted by all the exotic products that are out there.
So I think for investors, the main thing is just to be aware of what you're buying. Try and stick to the basics. Don't get distracted because there's so much different product out there. I think for most investors, a best practice is try not to get too cute with your portfolio and too specific in your allocations. And for broad market ETFs, I mean they're typically going to be quite similar from the different major ETF providers in the country.
All right. Thanks, Erika. I appreciate you coming in today and sharing your insights with us.
It's my pleasure. Thank you so much for having me, Dan.
It is time again for an installment of
Bad Investment Advice,
where we look at the ways the media and the financial industry do their best to sabotage your long-term plans. This time I'm going to take a look at an article that was sent to me by a listener. It was published by Invesco, an enormous mutual fund and ETF provider, and it's called Addressing the Risks of a Top-Heavy U.S. Equity ETF. Now, the article doesn't actually focus on a specific ETF. Instead, it takes aims at all index funds that track the S&P 500 index, which is the most popular benchmark for U.S. stocks, and by extension, all traditional index funds that weight their underlying stocks according to the size of the company. Now, before we go further, it's worth reviewing how traditional indexes are constructed and why, and then we can consider whether other methodologies might be better. Traditional indexes like the S&P 500 or in Canada the S&P TSX Composite Index are built using a methodology called capitalization weighting, or just cap weighting for short. A company's market capitalization is calculated by multiplying its current share price by the number of shares outstanding in the market. For example, the largest company in Canada by market capitalization is Royal Bank, and they actually make the math quite easy for us, because Royal Bank has approximately 1.44 billion outstanding shares, and the stock is currently trading right around $100, so its market cap is about $144 billion. That's large enough to give this company a 6.5% share in a cap-weighted index of the Canadian stock market. Now, the other companies in the top 10, not surprisingly, are the other four big banks, as well as CN Railway, Suncor, TC Energy, Brookfield Asset Management, BCE, and Shopify, all of which make up at least 2% of the overall index. Other companies that you might have heard of, such as Sleep Country, Hudson's Bay Company, and Cineplex, are much smaller when measured by market cap, and these make up a fraction of 1% of the index. Now, the S&P 500 includes 500 of the largest companies in the U.S., and it's actually a bit less top-heavy than its Canadian counterpart, but there's still some pretty big names here. Microsoft now makes up about 4%, followed by Apple and Amazon, both of which comprise more than 3% of the S&P 500. Now, all of the companies in this index are huge, but those near the bottom of the list, such as Nordstrom, Harley-Davidson, and H&R Block, as well, ironically, as Invesco, make up only about 0.02% or less. As you've probably figured out, the performance of the large companies in the index are the real drivers of performance. If the banks have a very good year in Canada, for example, investors who hold traditional equity index funds are likely to do very well because these banks dominate the indexes, whereas the smaller companies barely move the needle. Sleep Country could have a phenomenal year and it wouldn't make much difference to index investors. You might as well have just put your money under the mattress. Sorry, couldn't resist. Anyway, this characteristic of cap-weighted indexes is often made out to be a structural flaw because it supposedly means that it gives investors too much exposure to very big and potentially overvalued companies. In the Invesco article, the author writes, quote, "As a small number of already large companies have skyrocketed, investors tracking cap-weighted indexes have unwittingly increased their exposure to these winners. At the same time, they've been decreasing their exposure to companies that have lagged the overall index. Put another way, they've been buying high and selling low." Close quote. So if cap-weighted indexing is fundamentally flawed, what's the alternative? Well, the Invesco article sings the praises of an equal-weighted strategy, which isn't a new idea. In fact, Invesco has had an equal-weighted S&P 500 ETF for many years now in the US, and in May, the company launched a Canadian version that's now traded on the TSX. As the name suggests, rather than combining all 500 companies in the index according to their market cap, an equal-weighted strategy simply holds the same amount of each. So in this case, each of the 500 companies is assigned a weight of 0.2% in the index. So giants like Microsoft and Apple have the same influence as much smaller companies like Nordstrom and Harley-Davidson. But then here comes the kicker. The author states, quote, "Historical performance data for the S&P 500 Equal Weight Index shows that it has consistently outperformed the market capitalization weighted S&P 500 over the long term." Close quote. Well, that's certainly a compelling claim, and it's worth investigating. And there should be plenty of data here, too, since the S&P 500 has been around since the 1950s, and high-quality market data on U.S. stock goes back at least to the 1920s. But when you check the footnote in the Invesco article, you'll learn that the outperformance was measured from April 1st, 2003 to March 31st, 2018. And in fact, data with those same start and end dates is also featured prominently on the promotional material for the new Canadian version of the equal-weighted S&P 500 ETF. But does this show that the strategy has consistently outperformed over the long term? It's 15 years of data. That might be long-term for people who watch BNN every day, but this is hardly a robust data set that one can use to claim superiority over traditional indexing. Over every 15-year period, it will always be possible to find a different indexing methodology that would have beaten cap weighting. But that has no value unless investors can reasonably expect that outperformance will continue in the future. So let's put this one to the test. What would happen if you took that April 2003 start date and extended it backwards 15 years instead of forwards? Which methodology outperformed during that period? Unfortunately, we don't have data for the equal-weighted S&P 500 index for those years, because at the time there were no funds using the strategy. But we can consider a proxy. Think about what happens when you assign an equal weighting to the top 500 companies in the U.S., rather than using a traditional cap-weighted methodology. In the equal-weighted index, the average market cap of the companies is going to be much lower. In other words, if a cap-weighted index gives disproportionate influence to the largest companies, then an equal-weighted index gives a disproportionate influence to what we would call mid-cap companies. So while it's not a perfect comparison, it's reasonable to use the performance of mid-cap stocks as a proxy for how well an equal-weighted methodology would have done during periods for which we have no index data. Unfortunately, we do have a very large data set for the U.S. market, subdivided by company size. So for large cap stocks, we'll use the top 20% by market cap, and for mid-cap stocks, we'll use companies in the next 30%. And indeed, if we look back at the period that Invesco considers, from April 2003 to March 2018, the outperformance of the equal-weighted S&P 500 index corresponds with the outperformance of the mid-cap index. Specifically, during that period, large-cap U.S. stocks returned just over 10% annually, while the mid-cap index returned 12.5%. However, over the previous 15 years, that is from April 1988 through March 2003, large-cap stocks outperformed mid-caps by about 0.8% annually. And what's more, during the full 20 years preceding the dot-com crash in March 2000, large caps also outperformed mid-cap stocks by about the same amount. Now, don't get me wrong, the lesson here is not that you should favor an index methodology that gives greater emphasis to large cap stocks. The point is simply to appreciate that different segments of the markets will always outperform over certain periods, and you can always create a back-tested index focusing on that segment of the market, whether it's mid-cap stocks, small caps, value, sectors, or something else. So there's nothing inherently wrong with an equal-weighted S&P 500 index fund, and if you want to use one for your U.S. equities in your portfolio, I won't try to stop you. What worries me is that the search for a better mousetrap is a huge distraction to a long-term investing strategy. If you're going to be an index investor, you need to get used to people disparaging cap-weighted indexes. They're routinely presented as fatally flawed investment strategies, and not only by companies like Invesco that sell alternative products. Even academics like to pile on. Several years ago, the Cass Business School in London, UK, published a pair of research papers comparing traditional indexing to 13 alternative strategies for U.S. stocks from 1968 through 2011. The alternative strategies not only included equal weighting, but also methodologies that weighted stocks according to fundamentals, such as dividends and price-to-book ratios. During the period they looked at, a cap-weighted strategy derived an annual return of 9.4%. Meanwhile, every single alternative strategy they looked at did even better. They all came in between 9.8% and 11.5%. The researchers even did a simulation in which they randomly generated portfolios of 1,000 stocks each, which were then equally weighted. Quote, effectively, we programmed the computer to simulate the stock-picking abilities of 10 million monkeys, the researchers wrote. And the results, quote, nearly every monkey beats the performance of the market cap index. Now, this is all good fun, but what does it mean for the average investor? You know, for me, it's always come down to this. It's great that academics have found that every strategy under the sun crushes the humble index fund, and yet here in the real world, the reality is quite different. Over every meaningful period, traditional index funds outperformed the vast majority of alternatives. Part of the reason, of course, is that cap-weighted ETFs, for all of their flaws, have the lowest fees and the lowest turnover in the universe of available funds. But it's not just about cost. Research by firms such as Dalbar have shown that individual investors routinely underperform by even more because they jump from fund to fund chasing past performance. You know, maybe it's true that nearly every monkey beat the performance of the market cap index, but here in the real world, precious few monkeys have actually enjoyed that kind of track record. There are many reasons for this, but the most persistent is a lack of discipline and an inability to stick to a long-term strategy. During the 15-year period when Invesco's equal-weighted S&P 500 ETF outperformed the broad market, it would have been easy to stick to that strategy. But I'm not so sure that would have been the case during the even longer periods when its performance would have lagged significantly. Of course, those who use traditional indexing strategies can lose confidence too, especially during a deep bear market. Couch potato investors are not immune to the temptation to abandon their long-term plan, but they probably are less likely to be seduced by alternatives because they've accepted that, to paraphrase Winston Churchill's comment on democracy, cap-weighted indexing is the worst investing strategy except for all of the others. For all of their faults, traditional index ETFs are the cheapest, simplest, and most tax-efficient way to build a diversified portfolio that will give you the exposure to virtually all of the entire global equity market. And if that's not enough to enable you to achieve your financial goals, then something other than your investment strategy is to blame. There are many reasons why investors fail, but the shortcomings of cap-weighted indexing are not among them. Fund companies suggesting otherwise are just spewing more
bad investment advice.
And we're going to reach into the mailbag for another installment of Ask the Spud, where I answer questions from listeners and blog readers. And with me, as always, with today's question is my colleague Amanda Diel.
So today's question comes from Jim, who writes, I spoke with my financial advisor about transferring out of a mutual fund with a 2% MER to a discount brokerage so I could get started with one of Vanguard's asset allocation ETFs. He told me something that I had not realized. He said on top of the ETF's 0.25% fee, I will also pay the MER of each underlying fund. There are 7 of these, each with a fee of roughly 0.2%. That works out to another 1.4%. Which means my overall cost would be 1.65%. I thought the 0.25% was the only fee I would incur when investing with an asset allocation ETF. Have I been wrong about this?
Thanks for this question, Jim, and let me assure you it's not you who has been thinking about this wrong, it's your advisor. He's actually made 2 fundamentally incorrect assumptions here. And for someone who makes his living selling investments, these are unforgivable. But if you're a new investor, you might have wondered the same thing. So let's dispel these 2 misunderstandings now. Now, Jim is considering investing in one of Vanguard's asset allocation ETFs, which allow you to buy a fully diversified portfolio with a single product. The other major ETF providers in Canada, iShares and BMO, also have their own family of asset allocation ETFs, and they're all built the same way. Each fund is a kind of wrapper that holds 6 or 7 underlying ETFs covering the global stock and bond markets. These asset allocation ETFs have management fees, of course. In the case of the Vanguard products, the MER, or management expense ratio, is 0.25%. And each of the underlying ETFs also carries its own management fee. So it's reasonable to ask whether ETF providers are double dipping. In other words, if you buy one of these asset allocation ETFs, are you paying the management fee on all of the underlying funds plus an additional 0.25% or so on top of that? Well, let's be very clear about this. The answer is no, you're not paying twice. all of the asset allocation ETFs waive the management fee on the underlying funds, and they only charge you that one overall fee, in this case 0.25%. This is disclosed in the prospectus of each fund, so I'll quote from Vanguard's. Quote, "There shall be no duplication of management fees chargeable in connection with the Vanguard ETF and its investment in underlying funds," close quote. You know, this fund of funds structure is not unique to asset allocation ETFs. Lots of balanced mutual funds have been using this structure for many years. They might have individual funds for Canadian equities, U.S. equities, international equities, and bonds, and then they wrap up all of these asset classes in a convenient balanced fund. Investors who use this product pay only the published management fee, not one layer of fee on the underlying funds and then a second fee on top of that. So let's move to the second argument that Jim's advisor made, which is actually much more problematic, but it is one that I've heard many times. Vanguard's asset allocation ETFs have 7 underlying funds, 3 for bonds and 4 for stocks, each with its own management expense ratio. Now, as we've just said, these fees are all waived inside an asset allocation ETF, but let's assume that you held each of the 7 ETFs individually. What would the overall cost of your portfolio be? Well, the 7 ETFs have MERs that range from 0.06% to 0.38%, averaging right around 0.2%, as Jim's advisor noted. However, the advisor assumed that the investor's fee would be 0.2% times 7, or 1.4%. But of course, this is terrible math. In order to calculate the total cost of the funds in a portfolio, you don't simply add the fees together or multiply the average fee by the number of funds. Think about it this way. If you own 50 mutual funds that each charge 2% annually, does that mean your portfolio's overall fee is 50 times 2% or 100%? When you put it that way, it becomes obvious this is absurd and it can't be the case. The proper way to calculate the overall fee in a portfolio of ETFs or mutual funds is to first multiply each fund's fee by its weight in the portfolio, and then to add these numbers together. So here's a very simple example. Imagine you have a portfolio of just 2 funds, a bond fund that makes up 25% and an equity fund that makes up 75%. Now we'll assume that the bond fund carries a fee of 1% and the equity fund charges 2%. So what's the overall cost of the portfolio? Well, we start by taking the bond fund's fee, 1%, and multiplying it by that fund's weight in the portfolio, which is 25%. 1% times 25% equals 0.25%. Now we do the same with the equity fund. We multiply its fee, 2%, by its weight in the portfolio, which is 75%, and we get 1.5%. Now we add these together. 0.25 for the bonds plus 1.5 for the equities equals an overall cost of 1.75 for the portfolio. Now, the math is a little more complicated for a portfolio like the Vanguard Growth ETF portfolio, which has the ticker symbol VGROW. It has 7 funds, as we've said, and each of these has a different weighting. So you'll need a spreadsheet, but the process is the same. So the largest holding in this ETF is the Vanguard US Total Market ETF, ticker VUN, which has an allocation of 32.5% and a fee of 0.16%. You multiply these two numbers together, you get 0.052%. You follow the same steps for the remaining 6 ETFs in the portfolio, and then you add up all 7 numbers to learn the overall cost. In this case, the 7 underlying funds in VGROW, if you held them individually in the same proportion, would have an annual cost of about 0.16%. Remember, the MER on VGROW is 0.25%, so you are paying a little more, 9 basis points, for the convenience of wrapping up your whole portfolio into a single fund. But for the vast majority of investors, this additional cost is well worth it. Not only does it mean you'll never need to rebalance your portfolio, it also means that anytime you add new money to your account, you can make one trade instead of several. 9 basis points is just $9 a year on every $10,000 you invest, and many brokerages charge $10 per trade. Even if you're trading ETFs for free, an asset allocation ETF imposes a discipline on your strategy. Neglecting to rebalance, or worse, tinkering with your portfolio, can easily cost you more than 9 basis points a year. So rest assured, the asset allocation ETFs from Vanguard, iShares, and BMO are not part of a vast conspiracy to charge you 1.65% for a portfolio of ETFs, no matter what the guide the bank might try to tell you. Instead, they remain the most efficient way to build a globally diversified portfolio at rock-bottom cost. And that's all for this episode of the Canadian Couch Potato Podcast. And I have a little announcement to make. After almost 3 years, I've decided to take an indefinite hiatus from the podcast, so this will be the last episode for the foreseeable future. While I've enjoyed the ride, it's been increasingly difficult to carve out the time to write and produce new episodes, even once a month. So I want to thank everyone who has helped put together the podcast, especially Tara Hunt, who helped us launch back in 2016, Nick Jaworski, our producer extraordinaire who made me sound professional, Amanda Diel, who added her voice and personality to the Ask the Spud segments, and to my other colleagues at PWL Capital. But most of all, my sincere gratitude to you, the thousands of listeners who downloaded every episode and shared your feedback and support. You can find an archive of past episodes and show notes on my blog, CanadianCouchPotato.com, where I'll be rolling out some changes over the next few months. Thanks for listening.